Hi, everyone. This is Jason Bierk of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest, Craig Hemke of the TF Metals Report. Thank you for joining me again.
Jason, my old friend, it's always fun to visit with you.
I agree. And we could talk about a lot about the macro situation first before we get into gold and silver. For listeners out there, we're recording this interview on Thursday, September 14th, 2023. Gold prices are down substantially in the last month or so, still above 1900, but at 1910. Silver prices have corrected. They did rally, I think, last week or the week before, almost to 25 or around there. They're back down to $22.62. Craig, I want to get your thoughts, though, on the global macro situation, budget deficits, what the Fed is doing. How would you describe the global economy right now and what the Fed has been doing lately?
Well, I tell you, Jason, this has been a maddening year for anyone like me that, puts so much of their focus on the precious metals. Yeah, I remember probably when the last time we spoke, we talked about how I write these forecasts in January every year. If anything, give me something to review later in the year and hold myself accountable and try to learn, what did I get wrong? Because you're always going to get stuff wrong. And I really thought this year would be a lot like other years in the past where the Fed had tightened so fast that eventually the economy breaks down, can't handle higher interest rates. And they're forced to, through liquidity reasons and everything else, to start cutting. And once they, the market recognizes that's the way forward, then that's when the metals soar. We saw it in 2010, 11, 2018, 19 into 20. And I really thought by here later in the year, those signs would be present. And man, we have really had a very tough 3 or 4 month run in a row, particularly the last 8 weeks. The dollar index has been up. Well, as we record this, it's about to paint its 9th consecutive green weekly candle on the chart. Longest winning streak it's had since like 2007. And so it's been a very frustrating year. Gold's up, though, $100 so far year to date. So even in a frustrating year, it's on track to kind of meet its average annual gain over the last 20 years, which is about 10%. Eventually, I just can't imagine, Jason, with the lagging effects, that and all the unknown unknowns of what the Fed has done in hiking rates this aggressively, ostensibly to control inflation. I just can't imagine that we're not eventually spiraling into recession. But clearly it's not happening in the time frame that I thought it was going to happen when I wrote everything out 9 months ago. And that's a part what's so frustrating.
Yeah, I think that there's lag effects that will eventually kick in with the interest rates at these levels, but we're seeing the bad news stories every day about whether it's credit card debt, auto loan problems in commercial real estate, regional bank problems. I think this past weekend, according to a community bank or a regional banker who leaked something anonymously under a community bank or regional banker Twitter handle without their real name, they were saying that the Federal Reserve Bank was calling around regional banks asking about exact percentages of commercial real estate exposure. So, but in perspective, Craig, I think with the gold price, we have to look at the other gold prices with the other currencies. So the dollar gold price actually, yeah, it's had a correction, but in the past years ago, and I was thinking about this a couple of days ago when I knew I was going to have you on for an interview. In the past, when the dollar was rallying, when the Fed was raising interest rates, the gold price could have crashed in the past. We could have been down at like 1,600, 1,500. We're not getting that because I think the gold prices in other currencies and the private sector demand for physical gold outside the United States in these non-G7 countries in emerging markets and by non-G7 central banks, it's very, very strong.
Yeah, you look at real interest rates, which, based off inflation expectations are sharply positive, and negative real interest rates are usually when, such a positive time for gold. So I'd throw that log on the fire too. Why is gold still 20% higher than it was a year ago at this time? I wonder if it isn't a little bit like, why is the stock market still going up? That there's, for hedge fund managers and anybody else that trades the futures contracts, if there isn't still kind of a fear of missing out, rather than fear that everybody just has the same outlook that I do, that eventually it's going to change. And man, as soon as it happens, gold's going to soar, and go to new all-time highs. And I don't want to miss it. And so that on top of central bank demand and the other factors you mentioned probably probably playing a role in, like I said, keeping it's 20% higher than we were down at 1650, something like that. At this time last year, dollar index is about where it was this time last year. Interest rates are nominal rates, 10-year note. Those rates are even higher than they were last year, but here gold sits, 1930 or whatever it is. So it's a bit of a paradox that it's hanging in there as well as it is. And again, I think there's some of that fear of missing out is in there. Just remember, we went from Powell talking about how great everything was and how strong the system was and higher for longer on March the 7th at his Humphrey Hawkins testimony. 3 days later, Jason, we got Silicon Valley Bank, and gold went from, whatever, it went from 1880 to 2100 almost in a period of weeks. And, as soon as the markets get a hint that, this tightening cycle is over, we may very well move up pretty quick.
And speaking of 2100, the actual price in US dollars for an ounce of gold in mainland China. So private sector, if someone in mainland China wants to go buy an ounce of gold, it is right around 2100. It's just under 2100. I think last night, it was like $2,070 an ounce. It was close to those levels. So there's a big, my point here is that the demand for physical gold in Japan for private sector, I think it's at an all-time high in Japanese yen, and look at their currency. So if you're an affluent Japanese investor or saver, and your currency is at a 52-year low or something like that, and you have really bad stagflation and inflation, you're looking to buy gold. I think it's at an absolutely insane price for physical gold in Japan, and the price for physical gold in China, mainland China, is also very high. So it's all relative which country you're looking at.
And again, in China, for some of the same reasons as in Japan, the dollar yuan has been soaring, meaning that the yuan is getting weaker. And so maybe, that's kind of factoring in too. Now, that's a really interesting situation there because that spread is so wide. It's not, where it's maybe 6% today of the premium from Shanghai versus, we'll call it New York, London, but it's almost 10% in silver, Jason. I mean, the Shanghai silver price, as we record this, like 25.50 versus sub 23 on COMEX. And so I don't know,
So if you're a bullion bank, Craig, if we're bullion bankers, then we're going to go raid the GLD and SLV. We're going to go hire a cargo plane, and we're going to send that tonnage, that gold and silver tonnage. We're going to be shipping it to Beijing and Shanghai then, right? And we're going to earn those millions of dollars in extra premiums.
You would think. I mean, that's the idea, right? It should be arbitraged, and that gap should close, but instead it keeps widening. And as you mentioned, Jason, there's logistic, questions involved to get gold from London to Shanghai, because to close that arb when it's set up like that, then you're going to be buying in London and selling in Shanghai. Well, that's a physical only market, so they're going to expect you to deliver actual metal. If you're saying
it'll probably take at least a week probably to get all the logistics settled, to get the cargo plane and the armed security guards, so the plane isn't taking like a James Bond movie in midair, and then you have to buy insurance and probably.
So it's not like, a stock versus an ADR in another country, and there's, you can arb that out, in a fraction of a second. This is an actual logistical thing. And maybe that premium's got to be even wider than 6% to make it profitable to do. I don't know. I just recording my daily podcast for everybody on my site, and I was discussing this today. It's anecdotal. Maybe it's anecdotal of something even more significant. We don't know. It's similar to, like just yesterday in my podcast, I was talking about new all-time highs in cattle and orange juice and sugar, or multi-decade highs. And you're like, okay, so is that a sign of a new commodity bull market? Or is it just simply a sign of the specific fundamentals to that each specific commodity? I don't know. It's hard to extrapolate it. And the same thing is kind of true here. You see these premiums in China and you think, is this a sign of a global paradigm shift? Maybe, but I'm not sure we can read into that yet, though. But Jason, I remember when they first set up that Shanghai exchange about 10 years ago, the thought was, here's a way to kind of somewhat internationalize the yuan, or renminbi, that you could take it there and you can convert that into gold. Or maybe you sell using the renminbi, the yuan, whatever term you want to use, you sell your crude oil in that. And now you've got, rather than dollars, you've got renminbi. Now, what are you going to do with it? Well, here maybe in Shanghai, here's an easy way to convert it to gold. And so I don't know if these things tie together or not. I mean, especially, crude's up from 65 to 90. Since that BRICS summit 3 weeks ago, though, it's gone from 75, just below 80 to above 90. At the same time, this big gaping hole, this big gaping premium between Shanghai and London has opened up. You've got the Saudis and the Russians have come out and said that they'll accept renminbi for crude oil. I don't know, maybe this whole system that was set up 10 years ago is starting to be utilized. I don't know. Like I said, I don't want to extrapolate.
Well,
it's all kind of anecdotal, but
I think oil more has to do with supply demand fundamentals, because demand globally has actually been better than people thought. Now China air travel is coming back. You actually had a lot of emerging market oil, gasoline and diesel demand. And then on top of that, on the supply side, not only did you get Russia and OPEC maintaining the production cuts, and they cut earlier than people thought months ago, but you also have supply problems with the Permian Basin. I don't think there's going to be a lot of production growth coming out of the Permian Basin in the U.S. And then you have lack of investment there on the supply side. So there's a lot of depletion there too. And then the strategic petroleum reserve stuff. So I think like oil has more. Oil is tougher to do with a lot of papers futures contracts, because once the gasoline is used, it's really tough to find cheaper oil again. So it's not quite as easy to play the paper games with it. Also, the Saudis, 6 months ago, you had the Saudi oil minister, and he was talking about paper futures contract manipulation in the oil market. And he said, okay, if this is going to continue and there's a lot of paper futures contract manipulation, we're just going to keep cutting production. That's what he said.
Yeah. And, there's a lot of people who think that the Federal Reserve Bank of New York trading desk is in there playing with crude oil futures to help out, the Biden administration trying to get the price down through dumping out of the Strategic Petroleum Reserve. Whether or not that is going on, I don't know. But that SPR, they're starting to try to refill it.
I don't think they're going to be able to refill it meaningfully, Craig. I honestly don't. Whoever is after Biden for 2024, 2025, 2024, 2025 in the White House, the next administration, it's going to be their problem. But I mean that they can't manipulate the market the same as gold and silver, though, because the gasoline and the diesel and the jet fuel, it's all needed. The petroleum products are needed, used up, and then we have to find more cheap supply.
I agree. And then on that demand, on the other supply side, like you said, the U.S. dumping 300, 400 million barrels, whatever it was, that they supplied out to the market over the course of a year and a half to try to tamp down the price. That supply's gone. Obviously now they're even if it's just 3 million barrels a month, that's now going the other way.
Well, they got the oil price, the West Texas Intermediate oil price, the futures contract, I think down to 64, 65 a barrel. That was as low as it was going to get. I mean, the average American listening to this podcast, your gasoline prices were still sky high, but they got the futures contract down. But all the oil producers, I mean, if they would have gotten, and there was a ton of hedge funds that were net short then because the short-term trend was down. But anyone who knew the production cost for American producers for the industry, a lot of the industry knew that if oil prices went to 60, 55, 50, I mean, a lot of the producers with cost of capital and interest rates, a lot of the producers were either going to shut off production or go bankrupt if oil prices kept going down. So it was obvious we were going to have a rally and that OPEC was going to eventually cut.
Yep. And, you have told me before about what happens when there's a really good run of profits for Middle Easterners and, in the Emirates and all the other kingdoms over there. What they do with their excess profits often goes into gold.
Well, that was exactly what the Hunt brothers did. The Hunt brothers were actually copying a trade. They were friends with all the Saudis and all the OPEC guys, the oil guys back in the 70s. Now, the Hunt brothers got greedy. The Hunt brothers started leveraging up with the futures contract on the COMEX and all the rules changes. They got screwed over on that. But had they just bought physical metal and just opened up their silver mines, they would have been okay. So they were just copying what the Saudis and OPEC were doing with those oil profits, what they like to do. And they were doing this 12 months ago. When oil was rallying in 2022, the Saudis and OPEC, when they had those enormous oil profits, they were adding tonnage.
There you go. You could be headed down that road again. And again, maybe all that is supportive of gold. I don't know, this has been a very interesting year, that kind of transition year from, this rate hike scheme that began, whatever it was, March of 22, transitioning through this year to what will be the next series of rate cuts and obviously renewed money printing. I mean, the cash has got to come from somewhere to fund all the deficit spending and service on the debt and everything else. So we're going to live through this transition year is what it seems like. But man, the piper's still going to be paid. Economic mother nature is still going to come roaring back next year. And I still can't imagine that in the end, we're not going to be right about, the forecast for where things are headed.
Well, Craig, you mentioned developing countries or oil countries or emerging markets buying physical gold tonnage or thinking about buying. We see this in the data. I mean, look at what the central banks, the non-G7 central banks, Singapore, Poland, many of the other, it's all the large net purchases. I think the People's Bank of China has increased purchases 7 months in a row, 7 or 8 months in a row, something like that. It's all from the non-G7 central banks, and their alternative for central banks. I mean, the two main assets for a lot of these central banks, for our listeners out there, they can either buy U.S. Treasuries. And right now they could buy short-term U.S. Treasuries, quote unquote, risk-free, 5%. So, and instead they're choosing not to. So I think that's obvious. And you're seeing the majority of Treasury demand right now is from retail, from people who were earning like no interest in a bank account, in a checking or savings account, and they're taking their cash out of regional banks and they're going into money markets and they're going into Treasuries.
Yep. And that's another looming lagging effect of this, kind of indiscriminate hiking policy that the Fed has put out there. I mean, we had already, the second, third, and fourth largest U.S. bank failures of all time back in March and April. The Fed had to roll out what's the name of that program they came distress?
Bank Term Funding Program, because I used to say BTFD. I used to say that was like a Freudian slip at first, but it's Bank Term Funding Program. Yeah, but, I mean they've been borrowing from the FHL, the regional banks, and the others have been borrowing from the FHLB and others. So these are these shadow liquidity programs. Yeah,
papering over the problem really, because ever since the great financial crisis, these banks either hold stuff to maturity or they hold it where they market to market every day, giving them, when rates have moved against them, this appearance of insolvency. And so that bank term funding platform program, whatever that they built, allows these banks to take the stuff that's marked as to maturity, that's trading at maybe, 70, 80 cents on the dollar, 90 cents on the dollar, whatever, and just give it to the Fed. It's like a Fed put. Here, you hold it. We'll take the cash now. We'll put it to you. You give us, full 100 cents on the dollar, and then you can hold it to maturity. And what's that up to now? $110 billion? I mean, it's growing every week.
You also have the FHLB, like I said earlier, that's the other shadow liquidity program. That was, I think, up to 1.3 trillion or something like that a couple months ago. That was at an all-time high. I mean, that liquidity is ending up in the stock market, though. So if the banks are tapping it, they're using that stuff as collateral. I think a good chunk of it's ending up in the stock market. But an important point here, Craig, is that these foreign central banks with their trade surpluses, their foreign exchange reserves, they could be buying treasuries, and they're not. So I think we saw Keith McCullough from Hedgeye, the CEO of Hedgeye, he put out an interesting fact earlier this week saying that the net sales of treasuries for China and Japan are down enormously. So they're not net buyers of treasuries anymore. They're actually, over the course of the last 5 to 7 years, they're actually large net sellers now.
And, now we're getting to the crux of why I've had a website for 13 years. We've always talked about the end of the great Keynesian experiment is what we're preparing for. That's been my tagline since the zero hedge days in 2009. And Keynes is the father of this debt-based system, which works just fine, for a while, as long as, the amount of debt is serviceable and you get equivalent amount of growth or even more growth for every dollar of new debt you take on. But now we're in that kind of terminal exponential phase where it's going the other way. And I don't see a way out other than renewed monetization of the debt by the Fed. Kind of the same path that the Bank of Japan's been on. Eventually it's going to have to take yield curve control. And so the Fed's going to be a buyer of everything above 3% or something like that, so that they can keep rates down so that the servicing of the accumulated debt stays down. And, it just, or at least is manageable. And again, I don't know how manageable it becomes. Here's another thing, Jason. You mentioned credit card debt. That is soaring as the savings rate, is getting, or the accumulated savings from the last couple of years gets wiped out. And at the same time, the amount of interest being charged by the banks on credit cards is at record highs. It's like what average? 22%? Have you seen that? Something like that. And the banks are predators and criminals, and I have nothing but bad things to say about them. However, they're not stupid. There are actuarial assumptions, like in a sense, built into those credit card rates, just like there are actuarial assumptions built into life insurance, right? And so the actuaries know how many people of a certain age bracket are going to die. And so therefore, depending on your risk pool of dying, you're going to pay a higher premium, you're not. Well, the same thing is the same thing can be applied to credit card rates. With people declaring bankruptcy, and just writing that off and running up a big tab, going out with a bang, and then declaring bankruptcy, that gets factored into those credit card rates. That's all part of why they're charging 22%. And so, that is another sign of underlying weakness and getting worse in the economy that not many people talk about.
Well, they're going to raise credit card, the interest payments on credit card off of the U.S. Treasury yield curve. So if the Fed's raising interest rates, then all the other debt's going to be priced higher off of that. And that's why you're seeing small businesses go bankrupt, higher credit card debt, auto loans that were maybe adjustable rate auto loans, and mortgages that are adjustable rate, things like that. Everything's going to be priced off the U.S. Treasury yield curve. But the private
Jason, but I agree with you, Jason. But again, we now have the highest credit card rates of all time, and rates are half of what they've been in the past, if that. So again, there are other things that are driving that credit card rate higher. And again, the only reason I bring it up is, again, it's a sign of those lagging effects. Remember, Jason, do you read that? I never even paid attention to it till Zero Hedge started making a big deal out of this senior loan officer opinion survey that the Fed does. That's another one the Fed puts out every 90 days. And the most recent one was like, oh yeah, overwhelming number of respondents expected tighter credit conditions, tighter loan standards. And again, all that does is ripple down, makes it harder for businesses to expand, makes them harder to grow and hire people, right? All of that is all part of this lagging effect thing that makes this recession kind of a self-fulfilling prophecy. Everybody wants to talk about soft landings and all this jazz. But, another thing I saw, since Google came into existence in 1999, the peak time of people searching the term soft landing has always been in the last couple of months before the recession hits. That's where we are again now. It's crazy.
I don't think we're going to have a soft landing. So I think that the recession was delayed by at least 12 months, but the next, 6 to 12 months are going to be pretty ugly from the data we're seeing with the Dallas Fed manufacturer survey. For the manufacturers here in the United States that were surveyed, what they said is that their input costs are still rising due to supply chain problems, higher energy prices, labor costs are going up. You have higher cost of capital priced off the Fed rate hikes. So if they're using debt or cost of equity, probably for a lot of industries, is also up as well. And then on top of that, not only do you have higher costs, your profit margins are getting squeezed in because you might not be able to get as many sales in because the consumer, if you're a consumer business, like a retail business or a restaurant, the consumer doesn't want to take on credit card debt. The consumer's probably already tapped out. We're seeing this too with the rise in home equity loans. So people want to use home equity loans because their home prices are still relatively high if they locked in a cheaper mortgage years ago, and they're using home equity loans to pay off some of that high interest debt.
Yep. All of that. And all of those, again, fall in that category, all these lagging effects. I saw a thing from David Rosenberg, the Canadian economist, the last 7 hiking cycles going back to 1964 or whatever, have all led ultimately to recession, but of varying lengths. So the shortest one was 13 months. The longest one was 32 months. So on average, it's about 21 months.
Well, correct.
And we are 18 months in.
So the big difference here is, I think, in the real economy, and I interviewed John Williams of Shadow Stats a couple weeks ago, I think the real inflation rate is much higher. On top of that, you have higher interest rates, but you also have the spending problem, the spending binge in DC. So the spending is just literally out of control I was speaking with a political strategist at a party on Labor Day, and they were basically saying that hidden in the Inflation Reduction Act, they had already gotten about 70% of the Green New Deal passed that was hidden in there. So there's way more spend. I think on the face, they said the spending for the Inflation Reduction Act was a little over $1 trillion. The reality is it's going to be at least 3 times that, but basically it's almost uncapped.
Yeah. Yeah. And 2 trillion in deficit. I mean, the fiscal year in the US is going to end in 2 weeks. I don't know what's going to eventually come in if we're going to get to 2 trillion this year, but it sure looks like it's going to be 2 trillion next year. I mean, even the CBO, for what they're worth, says 50 trillion in total debt by the end of this decade. And again, you just do some math. I mean, if that's on average being serviced at 5%, higher for longer, that's $2.5 trillion per year in interest cost as a line item. I mean, pretty soon that just absorbs everything. That's greater than Social Security. That's obviously far greater than military budget, all the other social programs.
Wait,
just servicing. And again, that's that terminal.
Wait, you're saying we're going to get to $2.5 trillion per year just in interest payments? Aren't we right now? We're only technically, I think we're only on a little over 800 billion a year right now.
Yeah. You think they fought it for years, right? I mean, the debt keeps growing, but that line item of interest on the national debt went sideways because they kept moving everything into the short end of the yield curve and got it down to, whatever the average maturity was, like 3.7 years at 2%. Well, again, short term, how's this going to work? Of the 32 trillion, currently 24 trillion matures, gets refunded and rolled over in the next 3 years. So that stuff's coming out of 1% and 2% coupons. And, if you believe the Fed, it's going to start being 4% and 5% coupons. And then the accumulated debt, just keeps growing with $2 trillion a year added on. So again, this is the CBO, the Congressional Budget Office. The numbers are always like, okay, whatever, anyway. But even they are saying we could, 32, 33, 34 trillion now. You add 2 billion a year or 2 trillion a year for the next 8 years. And holy crap, there you are, 50 trill. And just do the math. 5% on 50 trillion is 2.5 trillion a year.
There's just not enough demand from retail investors who are moving their checking and savings account savings into Treasury Direct to fund those types of deficits. Right. So in the past, for our listeners out there, you had the countries that were running the largest trade surpluses. So you had China, Germany, Japan were all subsidizing. It was vendor financing. They were all recycling their trade surpluses and foreign exchange reserves back into U.S. treasuries. Well, that's not happening anymore. We see that in the data. They're not net purchasers. Those countries are actually buying gold when they could be earning 5% risk-free, quote unquote, risk-free.
Yeah. And again, that's all part of this inevitability of how this is all going to play out. This is the cynic, the old man cynic in me, that there are people out there, whether they're in the financial services industry or the money management or their brokerage firms or they're the financial media, they all have an interest in keeping the plates spinning. So all you really ever get is the focus on, today's headline and, next quarterly earnings and all that stuff. You never, ever do you get a discussion of the big picture. Every once in a while, you'll see something on Twitter of Stanley Druckenmiller, being interviewed at some conference, and he talks about it, or something. But you never get this discussion anywhere. But the math is really a certainty, and then Jason, the only way the government takes in money is through tax revenues and fees, and things like that. In a faltering economy, that deficit widens even further between, the spending, but then the decreased amount of money coming in. And it just gets worse that much faster.
Yeah, I agree. We're seeing that in the data already. All the tax receipts for the private sector economy are already starting to fall rapidly here in the United States.
Yep. So, I sit here, watch this stuff every day, write about it, talk about it, do interviews like this one. And it can be on a daily basis exhausting, mentally exhausting. You feel like you're aging, 2 or 3 years at a time. But the big picture stuff, is what ultimately drives things, and it leaves me where it's like I'm trying not to focus so much on the short term because you lose picture of, you lose sight of the big picture, and Jason, even I'll give you this, even under the current pricing scheme, and it's always up to debate as to whether how fair it is and how appropriate it is as terms for price discovery. But you go back to 2003, 20 years ago, gold was $250 an ounce, so now it's what, it's 6x, 7x, whatever the math is in 20 years. So if let's just say that continues, right?
Yeah, it's
another
also been
20 years,
rising
what's
with
another 7x?
Craig, it's also been rising with the cost of production for a lot of these mining companies, because I don't think any mining company on the planet can produce gold at 250 anymore. I don't think most of them can't even produce it anywhere close to 1,000. Newmont Mining was telling people all for the last 12 months they could keep producing gold at 1,200, and they just announced their earnings 6 weeks ago. Their costs are back up to 1,500.
Yeah, right, exactly, and that creates a floor for things as well. In fact, actually, if you monitor the COMEX and the internal mechanics of how that, contract issuance and who's long and who's short and all that stuff, we've seen multiple occasions last year and now twice again this year, where as price falls and the speculating hedge funds are the ones that are driving it down, getting short because, they're trading machines, see the dollar go up. And so they just, without even thinking, they just reflexively sell and get short. It's the banks that are getting long. It's the banks that are responsible for physical delivery at that price in both New York and London, that they're the ones that are like, if this price goes down to 14, there's not going to be any physical silver left because the mines are. So then the banks start going long to make sure that they have metal to deliver against obligations. And it provides a bit of a floor. It's why silver got down to 18, 19, 4 times late last year. And then massive short squeezes came. There was one that was like 18% in 6 days. And we've had 2 so far this year from about the same price level we are now. I mean, there's a mechanic in there that really actually, as much as we hate, I hate the COMEX and the paper pricing scheme, there's some mechanics within it that keep the price from going down. And it's related to that all-in sustaining costs in the end.
Yeah, I agree. Because the physical demand market, because people still need the physical metal, especially industrial end users for silver, and there's rising industrial demand for silver, but also a lot of countries, these central banks, they want their gold tonnage. I mean, they're not keeping their gold at the New York Fed anymore. They're not trusting the LBMA or the Bank of England, because there's tons of evidence. What Ronan Manley has talked about this and written articles about this, that a lot of gold from India over the last 70, 80 years that was supposed to be parked at the Bank of England and the LBMA, that most likely the gold is gone.
Yep. I mean, he's done great work on how much, gold was just with clear title, that isn't already pledged and then hypothecated and rehypothecated. How much is there really at the LBMA? I mean, I think he's got 780 tons or something like that, which sounds like a lot, but it's not the amount that they're telling you it's based on, because then they include the Bank of England's gold, they include the gold that's held there by the ETFs and all that kind of stuff. Well, that gold's spoken for. You can't have, in the end, when there's a run and people actually want the metal, you can't have more than one beneficial owner, right? In the current system, you can have 100 of them.
Well, you also have all those derivatives tied to the actual metal or the paper ounce, the certificate claiming the 1 ounce of gold. So there could be over 100 times the amount of derivatives. So there's trillions in derivatives for pressure. I think according to the Bank of International Settlements, other than interest rate derivatives, I think the gold and silver derivatives in the commodities section is one of the larger amounts of derivatives.
Isn't that crazy? And really, in the end, what happened is after the London gold pool failed, which came after the U.S. trying to defend $35 an ounce on their own after World War II through the 50s. Then they came up with, hey, we can't do this by ourselves. And so they recruit 7 other countries to pledge physical metal, and that became the London gold pool. And then that failed. It's like, shit, there's just not enough gold to go around. And so the ingenious, if you will, move that was made was basically alchemy to get the world to accept other things as good as gold, the futures contracts, the ETFs, the unallocated accounts, that mints and bullion companies run, all of these things that are leveraged gold, where you create this system where there are multiple owners of the same ounce. And hey, it's like Keynes' system. It's fine until it's not. It's fine until it becomes untenable. It's fine until there's you can keep $100,000 in your bank, to service $1 million worth of loans. But if everybody comes and runs and wants their immediately cash and you don't have it, the bank collapses, right? That's what the bank run is. And so that, this fractional reserve system that we price gold, this alchemy, again, it works and it persists. And we've been at COMEX futures contracts for gold and silver were first rolled out in January of 1975. So damn, it's been almost 50 years. But that doesn't mean it's going to last forever. At some point, there's going to be a call to a carpet, a bank run, where, wait a second, that's my gold. No, that's my gold. No, it's somebody else's gold, and then that's when it gets interesting. But my point earlier about even under this current system, the last 20 years has seen gold rally, 6x? My math, what is that right? Maybe more than that, 8x. I mean, if it just does 4x over the next 20 years, we're talking almost $10,000 an ounce. And that'll help the mining companies. That'll help the exploration again, and everything else.
Well, it depends on the cost of production and the grades for the gold, because the grades have collapsed. I would make an argument that there's like almost zero $500 an ounce economic gold mining production, very little to zero of that left. And then probably 5 or 10 years from now, I don't even know how much $1,000 an ounce gold mining production there's going to be. We're really scraping the bottom of the barrel for average gold grades. We're at around a gram per ton average gold grades. Mm-hmm. And 10 years from now, Craig, we might be a lot lower than that.
Right. It's similar to what you mentioned about shale. It's worth extracting oil and gas out of shale and out of the sands of Alberta and everything else if it's $100 a barrel. You can't make it work at 50. And then all of a sudden supply goes down and price comes back up. It's similar to that, like you're saying.
Except the majority of the shale oil production growth here in the United States, I would say like pension funds, the Federal Reserve Bank, I think it was subsidized. Most of it was uneconomic.
Yeah, that's true too. That's true too. Nobody's subsidizing gold. That's for sure. I am.
Without oil, the whole pretense stops, because then the entire economy just grinds to a halt. Look, when electricity costs go up and oil, gasoline and diesel, those things, those prices go up a lot. Look at the economic activity, food prices, all these things are priced off diesel and oil and gasoline and cheap electricity. Economies can grind to a halt without cheap energy costs.
Yeah, that's for sure. No, that's for sure. But it'll be, again, getting back to the kind of the brick discussion and the currency discussion and these fiat currencies. We've been adrift and afloat and untethered now for 52 years, and we just go past that anniversary in August, right? At some point, all these fiat currency regimes fail. I was just in another interview with Kerry Lutz earlier today, and I was trying to remember, I think the guy's name is Dionysius of Sparta. He was a Greek, or Syracuse, and he was a Greek tyrant from the 4th century BC. And that's how far back the monetary record goes of currency devaluation. What he did to fund all of his wars and stuff, and the bills were getting so great, that he demanded all the citizens turn in their currency. And then he reissued it 2-for-1, devalued it by 50%. And suddenly he had the cash to pay off his bills again. And tyrants have followed his lead for 2,400 years since, Jason. And will do so again. That's the direction this is headed. And so when your currency fails and you get Weimar'd, you've got to come up with a way to put confidence behind it again. That'll retain some value. And the way that's always gone is you back it with gold or, whatever other hard asset that you can back it with to make it happen. Did you see, Jason, that video came out on Tucker Carlson's channel about Argentina? Did you see that?
I saw him comparing the U.S. to Argentina, but we haven't had a modern world excuse me, a modern world reserve currency have a hyperinflation. But we saw what, according to John Williams, the Shadow Stats in 2022, he said inflation got up to just under 18%. I mean, that's pretty darn high levels of
pretty bad.
stagflation.
Yeah.
So that's.
Well, I'm sorry, I didn't mean to interrupt you.
Well, I was just going to say that inflation was enough to cripple a lot of people. I mean, unless you're making over $500,000 a year and you don't have that much debt, so you either can pay off all your debt at the end of the month, or you have no debt, or you locked in a mortgage at a cheap rate. The majority of us at inflation rates that high and interest rates this high now that are priced off the Fed raising interest rates, I mean, we're getting squeezed really, really bad with stagflation, shrinkflation, taxes.
Yes. Yep. Well, and my point of mentioning Argentina is not to say that, we're months away from having that. I've actually called it Weimar Argentina, because what the Tucker Carlson thing mentioned is their currency is being devalued 10% a month. A month. How do you have a functioning economy under that regard, right? Because you're like, why would I sell you this and take, your currency in exchange for this when it's going to be...
There's a black market. Most of the people use dollars and they don't obey the official government exchange rate. Actually, like I've studied like their past hyperinflation. So like they changed the rules so many times. There was Argentinian investors, because I've listened to people that survived the hyperinflation. So people try to buy real estate, right? And they were like, oh, I locked in a cheap mortgage and the government's going to hyperinflate away my mortgage debt. Well, the government and the banks just changed the rules. And then they said, you're going to have to pay back your mortgage in the new currency.
Right.
And then people tried to park dollars or other currency right at their bank accounts in Argentina, and the government and the banks changed the rules. And they said, oh, you have foreign currency in your bank account here in Argentina. Oh, we're going to confiscate. We're going to do you a favor. We're going to I'm being sarcastic, obviously.
No,
They confiscated the dollars and the other foreign currency in your bank accounts in Argentina. And then the government took it and stole it. And if you've seen what happened to the last president in Argentina, Kirchner, they caught her and she's not going to prison for this. She had over $1 billion in one of her mansions. Did you see the video of this? And the police, when they raided, they had one of her mansions, she had a house, mansion, and the currency, the dollars and the euros and the gold bars and the Bitcoins on the USB sticks were all piled up to the ceiling. So they just confiscated out of people's banks. They just took all the dollars and the euros when their prior hyperinflation, like 25 years ago, and then they just forced people into the new currency that was devalued. The government just changes the rules all the time.
That's exactly right. And again, something else you got to have something. I guess my broader point. I mean, you got to have something to anchor your currency, to give it some kind of confidence, which is why they use the dollars rather than the local currency, right? I guess what I'm getting at is eventually that whole pendulum swings. That's how it's always worked. Even for Dionysius the First of Syracuse, you eventually devalue it so consistently that people just lose confidence in it, and then the thing completely spirals out of control, and you get the wheelbarrows full of cash. Famously, the pictures from Weimar Germany. Again, we're not on the verge of that, but the reason why I stack metal and talk about on my website, and so many people that use my site stack metal, because of that reason. That eventually you figure that the monetary system has to reemploy it somehow. That this protects you. This is your ship to get you through the storm. Because again, how can you have a functioning economy with a currency that is devaluing that quick? I mean, again, that's all part of why the Fed is fighting so hard against inflation.
You can't have a functioning economy because businesses can't literally, like, you sit down and eat at a restaurant in Argentina or Venezuela, and the menu could change every couple hours.
Right, exactly. Ridiculous. And that won't work. That's exactly right. And so anyway, the moral of the story is, I mean, again, this is not where the U.S. is now. And we may never get to that, crazy 10% a month inflation. I'm horrible. And Argentina is a disaster, in its current state. But at the same time, it can still be pretty bad. 10% inflation with a contracting economy and the Fed being forced to print and print and print to try to keep the plate spinning and cover the debt cost and putting in yield curve control and, monetizing everything, all of that, unfortunately, is our future. And so again, I sit here and My hair turns gray and I get stressed out and I got all these wrinkles from watching the COMEX price trade every day. But at the end of the day, I think I know, I feel pretty sure about how this all plays out. And I think if I can buy gold at below $2,000 an ounce, that's probably a pretty good investment.
And I also think if oil and the other energy prices continue to rally in the next, I don't know, 6 to 12 months, we have a substantial energy rally continuing. We're going to see those countries that are the larger energy producers, they're going to start diversifying those profits. They're going to start adding more tonnage of metal. You're going to start seeing that in the headlines in the next 3-6 months if energy prices continue on the rally.
Yep. No, and that's true too. And again, like we talked about, you remove, to what extent the U.S., draining half of its strategic petroleum reserve helped drive price from 125 to 65. Removing that excess supply and just shifts the supply demand curve. And that as a driver will keep energy prices high, keep inflation going high, puts the Fed in a conundrum of what are we going to do? At some point, they're going to be between a rock and a hard place. And for me, they have, ever since the financial crisis, when push comes to shove and they got to decide between their perceived competence or, whatever, or keeping the plate spinning, keeping the banking system afloat, that's what they choose. And I suspect that's what they'll choose again. I thought it would be this year, but not, maybe early next, but either way, it's going to happen.
Well, the main problem right now is not actually the Fed; it's what DC. Because DC, the Fed is the bartender that keeps serving DC drinks, and DC is already drunk, and no one, basically zero people or close to zero people that are in power in the White House or in Congress are actually talking about spending cuts. I mean, the whole thing with the debt ceiling, they called it "quote unquote" responsible government to raise the debt ceiling and make it uncapped for how long? That's responsible government. I mean, responsible government used to be balancing the budget, cutting spending, being reasonable and responsible, not like an uncapped debt ceiling and keep raising the debt ceiling so both parties can spend recklessly.
Yep. And that's how Pocahontas goes from, making $180,000 a year as a senator to now having $180 million net worth. Pretty good work if you can get it, I guess, right? Become a politician and become 9-figure wealthy.
Well, they make $10 million here when they come to DC. They make $10 million in under a decade now because of insider trades and side deals. There was a congressman that came out and the guy made $10 million on stock option trades. And he said the account was for insurance or diversification for his kids, except both of his kids are 14 and no stock brokerage is going to allow the 14-year-old to do trading.
And graft and corruption in your face. Nobody even cares to even do anything about it. Everybody's got to get their own. That's a sign of the times too, brother.
Well, that's all they talk about here at the parties now. Even if you go on TV and you say you're a Democrat and you go on TV and you say you hate capitalism and you say socialism's better and smarter and more fair and equitable. When the cameras are off and they're at parties or the expensive charity events that are over $10,000 a plate, all they talk about is how much money they're making, all the stock picks, all the extra money they're making from stock trades or other stuff.
Ridiculous. I tell you, brother, it is an interesting time to be alive.
It's basically, if you study history, it's basically what happened to Rome towards the end of the Roman Empire. The technology is obviously different, but humans don't really change that much in terms of human nature and human emotions and greed and fear and things like that. So the technology has improved, but that's really just allowed people to do a lot of other crazier stuff faster and more efficiently with the technology. So human nature hasn't really changed all that much.
Nope, sure hasn't.
Okay, Craig. Well, I enjoyed our discussion today. I think gold prices are going to go low to sideways in the short term, but I think if the energy rally continues, if you look at a chart with gold and oil, they've been acting actually inversely correlated lately over the last 12 to 18 months. There's more of an inverse correlation. I think it has to do with what we discussed earlier, but if the Fed's balance sheet reverses, if they have to start expanding it again to cover what government spending, the tax receipts collapsing, that's the real reason for QE. Like they say all these other bullshit stuff, right, for quantitative easing. The real reason for QE, Craig, what in 2008, 2009, and 2020, it was government tax receipts were collapsing. That was one of the main reasons, and to bail out corporations and the banks.
It's coming again. And again, where we started, this has been a frustrating year. but it's not as if the situation on the ground, longer term has changed. It may be put off by some economic data that's been surprisingly, a little stronger than expected, but that doesn't mean it's not coming. I'm not a buzz the field guy. I'm pretty sure a hard landing is incoming in the months ahead.
Yeah, I think a recession in the United States is inevitable. I think if you look at the data outside the United States, whether it's China, Germany, Japan, I mean, these economies are struggling. A lot of emerging markets are dealing with a lot more inflation relative to the developed world. So there's a lot of data with that. And then you have all the supply side problems on the commodities. So if you were diversified, you were listening to this podcast and you were diversified and you were buying energy when all the hedge funds were shorting it 6 to 8 months ago, you're sitting pretty right now. Uranium's had a nice rally. Oil's had a nice rally. So if you're looking, if that continues, oil prices continue to go up, might be smart to start diversifying, taking some profits and looking at gold and silver then if the energy rally continues.
Yep, I agree with you.
Well, Craig, please tell my listeners more about TF Metals.
Well, I alluded to this earlier. We've been around coming up on our 13th anniversary, which is, I just can't believe it. It's just crazy. But I'm blessed to run the site. It's not just what I do. It's the community of people there, from all different walks of life, from all around the world. But we're all it's not like it's an echo chamber, but I think we all recognize, the certainty of this math. And so we're all out, kind of looking out for each other, adding content through the day, really kind of being the eyes and ears for people. So I'm very proud of the site. It's only $15 a month. So it's not like it's a deal breaker. It's the same cost as a magazine or newspaper subscription, I suppose. I think you'll actually learn something, though, perhaps by being there. So hopefully people check us out. Just tfmetalsreport.com.